So a warm welcome to everyone, and thank you for joining this investor forum, which is being run jointly by Hardman Co and London South East. For those who don't know me, my name is Keith Hiscock and I'm the Chief Executive of Hardman Co. Today we have a special focus to the forum, gold and silver mining. We really couldn't be hosting this at a more appropriate time. Investors are attracted to precious metals in an environment where there is great uncertainty about most things, apart from a ballooning government deficit around the world, and the threat of negative interest rates also encourages investor interest in these fields. So the first company to present today is Shanta Gold. Shanta is a low-cost, high-grade East African gold miner, which is transforming from a single asset to a multi-asset producer. Sales in calendar 2019 were $113 million. The market cap is £173 million. Its largest shareholder is OD Asset Management, which has got just under 18%. And we're very pleased today to be joined by two speakers, the CEO, Eric Zurin, and the CFO, Luke Leslie. Eric, over to you.
That's great. Thank you very much. I'm assuming you can hear me okay, and looking forward to taking you through the story of Shanta over the next 20 minutes. Before I begin into the slides, it's worth just laying out who we are and what we do, because we've had a long history on the AIM market. Shanta has been listed in London since 2005. That's 15 years. And as a company, we've been producing gold for the last 8 years. We've produced and sold just under $1 billion of gold over our history. We're profitable. A lot of mining companies can't say that despite the commodity prices. And at the moment, we have now 3 assets in 2 countries with over 3 million ounces of gold contained in the ground. Now, for us, what's really interesting is we've now transitioned from a value-only story to a value and a growth story. And we'll take you through what that actually means and the reasons why we think it's particularly interesting to be looking at Shanta now. But remember this, at the current gold price, we're generating about $100 million US of EBITDA, which has us trading on about 1.7 times EBITDA. Our balance sheet is pristine. We have a net cash balance of about $35 million. By the end of the year, we'll be unhedged. And I would argue you'll be hard pressed to find a company as attractive on similar fundamentals and valuation. So what does the next few years hold? Well, let's start off on slide 3 to introduce myself and Luke, who will be speaking in a few minutes. We've been working together for the last, I believe, the last 13 years in different capacities since initially joining at UBS in London, UBS Investment Bank. We're supported by a very strong board who have experience across Deloitte, also at UBS, Rio Tinto on the technical side. And collectively, board and management own just over 7% of the company, which for me is very important because that aligns all of our interests. And as you'll hear later, Shanta is my single biggest personal investment. Now, if you go on to slide 4 of the presentation, and then on to slide 5, you can see here that we have 3 assets in 2 countries. We produce gold from our main asset called Mylchreest Gold Mine in Tanzania, where we've been operating for 20 years in the Republic. We have a multitude of catalysts over these 2 assets that demonstrate well over $600 million of NPV, despite our market cap being around about $200 million at today's share price. And as I said earlier, our portfolio delivers value and it delivers growth, whereas previously we were simply just a deleveraging story. Now, if you look at our portfolio on slide 5, you can see here the Mylchreest Gold Mine is the one that has generated all of our cash historically and will do for a little bit more time. But it is that asset that's in this cash harvesting period, which has allowed us the flexibility to pursue other options and the growth in our portfolio. Mylchreest is an underground gold producer. We will mine about 80 to 85,000 ounces of gold from this asset this year. It's low cost, high grade, and it's through an underground, predominantly underground mining method called long hole open stoping, which has a common link with the asset we've just acquired, West Kenya. Now, the West Kenya asset is one that we bought from Barrick. Barrick's the second largest gold company in the world. This was far too small for them. They acquired it from an M&A process that left this one as a non-core asset. Now, the good news about West Kenya is it's very well invested for what we've acquired. We've paid $14 million for this asset, which is roughly about 20 cents on the dollar versus what has been invested so far at this asset. But the headline grabbing number at West Kenya is the fact that it has 1.2 million ounces grading 12.6 grams per ton. And that is by far, as we understand, one of the highest grading, if not the highest grading, plus 1 million ounce deposit in all of Africa. We recently raised equity, and that was very deliberate, to invest directly into the West Kenya project. We'll take you through the merits of why we did that, why we think the reward of taking the reason for taking permanent capital today was far outweighed by the reward of the potential prize at West Kenya, and we'll take you through the reasons for that. Now, the third project we have in the portfolio as part of our growth is the Singida asset. It's one we've owned for about 10 years. It's a complementary add-on in terms of gold production in Tanzania, and this will take us up to 100 to 115,000 ounces of gold production in 2022. And at today's gold price, that would be over $200 million of revenue. If you go on to slide 3, now this really points to what Luke and I have been up to over the last 3 years since we took the current roles at Shanta. It's been a track record of delivering production and deleveraging the balance sheet over that period. And remember, that was at a much lower gold price. So you can see on the left-hand side of the page, we've taken the share of debt or of enterprise value. So this is net debt and market cap. And so we've taken the share of market cap to total enterprise value was 42%, which basically means the shareholders own 42% of the assets. To where it is today, it's well over 100%. So we basically have more cash than we have debt. And that was through very hard deleveraging, very hard decisions, cost control, capital management, and very disciplined production. What that's translated to on the right-hand side of slide 6 is a clear outperformance against our peers. We're up nearly 5 times from where we were 3 years ago, far better than our peers, and I think about 10 times better than the gold price. So overall, hugely rewarding. But if you look to slide 7 and you consider what's next, how do we take the share price up yet again beyond where we've taken it to at the current price? A lot of catalysts, and the catalysts come from the growth portfolio, or the growth in the portfolio. And I cast your attention to the West Kenya project, which we just acquired. As I said, this is Africa's highest grading plus 1 million ounce deposit understood across the continent. We have acquired it for about $12 an ounce. We think it's worth a lot more per ounce if we can deliver on demonstrable value at that project. And what does that mean? It means we have to infill drill. We have to put more holes into the ground to prove that with higher confidence there is economically statistical gold to be mined. And so this really is core to our value proposition, to the equity story, which is this growth lever that we want to deliver, and what we will be delivering on between now and the next 36 months. On to slide 8. You can see here on the value side of the story. So we've talked about the growth, which is West Kenya and Singida. A lot of growth to be had, more than doubling our production. We now have the value side of the story, which is our producing asset. Shanta's invested historically about $250 million into this asset, which means it's well invested and it's in a cash harvesting period. We often get the question, what are we going to do with the cash? Well, we're investing it into the Singida asset, which is now fully funded into production. And we've also committed now to a dividend. And that dividend will be paid in April. The board is conscious of having to declare a dividend policy. And I can put it in context. In the last year, I think we repaid about $20 million of debt against our market cap today of about 200 million. And so we'll be deploying some of our surplus cash as return of capital to shareholders. So there will be a dividend at Shanta in 2021. Make no mistake. On to slide 9, which speaks to how we operate in Africa. It's a very particular place to be successful. As I said, Shanta's been operating in East Africa for 20 years. I've been traveling back and forth to Africa for the last 7 years on a dedicated basis. And what's most important to us in Africa is maintaining our social license to operate. What that actually means is having the community and the host government wanting us to be successful in the country. Shanta's often been regarded as the showcase mining company in Tanzania. There have been some incredible headlines with our larger peer Acacia over the years, which hasn't fared so well. Shanta's been incredibly successful in Tanzania and will continue to be so. We have a very specific approach to operating in Africa where the host government must benefit and as I said, the communities must be beneficiaries of our presence. On to slide 10. And then I'll hand over to Luke to take us through some of the catalysts. But effectively on slide 10, what you see here is the value proposition. For the generalist investor, what does Shanta really boil down to? Well, on one side of the equation, you have our market cap, which today is about $200 million. No debt. We have just over $40 million of cash on our balance sheet. That cash is to be used to accelerate our growth. And the risk profile of the company is very attractive. Now, on the right-hand side, you have our 3 assets. And for a generalist investor, we often get the question, what are the assets worth? Well, the new Luika gold mine, the one that's producing, this is the value asset, we think is could arguably be worth the market cap. It's generating $100 million of cash flow per year. That works out to about $50 million of free cash flow per year. And that's very attractive. Now, the other assets, Singida and West Kenya, which are the growth side of the portfolio, we've published net present values at $1,700 a gold price per ounce. And that's 56 million at Singida and 340 million at West Kenya. So overall, we think there's about at least $600 million of value to play for against a market cap of about 200 million, with we would argue very little risk and a lot of potential. Now, what I'll do is I'm going to ask Luke to take us through the value drivers. This is starting on page 11. How are we going to demonstrate all of this value in our portfolio? What's really important for shareholders to focus on? And when can they expect to see some of the results? And so, Luke, if you don't mind, over to you.
Thank you, Eric. Okay, so over these coming slides, I'm going to talk to you, as Eric said, about the upcoming value catalysts, but also the investment proposition that we think the market is still to understand. So I'll start off here on slide 12. And this is the new Luika gold mine. So Eric's already spoken a bit about this. Each year of mine life generates an additional $50 million of free cash flow. And on this slide, what you can see is our track record in delivering that additional mine life. So each year when we explore, we replace the ounces that we've mined. Now, typically, we haven't spent a lot of money on exploration. We find that a relatively small amount allows us to extend and replace that mine, the ounces that we've mined. This year, we've already replaced 105,000 ounces, and we still have 3 rigs turning at New Luica. Next year, we'll be spending $7 million. And I think it's, I can say that we're getting some encouraging results, including at a new target called Porcupine South, and we'll be updating the market over the coming months on the ongoing exploration work at New Luica. Just turning now to slide 13. Now, there's a lot of data in this on this page, but there's 2 key value catalysts at Singida. Singida is our second mine. We announced that we started construction. We've completed some of the initial spend there, and we've committed to a first gold pour at the end of 2022. So far, on the basis of the internal DFS, we're assuming a mine plan based on less than 30% of the resources. And this is the second material value catalyst at Singida. The geology points to this reserve being much bigger. And we've committed $1 million to spend in Q1 next year, and we look forward to updating the market on what the reserve is likely to increase to. I'll just move ahead now to slide 15. And this is the new project that we acquired off Barrick. This is the West Kenya project. It's a very, very significant acquisition. We will be drilling, so in 3 phases. We're looking to convert into reserves 786,000 ounces. Now, when you look at the comps, we acquired this project for $12 an ounce. You look at the comps for high-grade projects like this, and they're valued around $300 an ounce. So that's the rationale for the equity raise. We're looking to convert those ounces in the next couple of years. Within 3 years, we'll have a DFS. I'll just finish off one more slide here very briefly, and Eric will just wrap up. Slide 16. Here you can see a number of upside targets in and around the Azuli and Bushi and Ngada resource. We remain of the view, as Acacia did, that there is 3 million ounces for us to discover in and around the existing resources. With that, I'll pass back to Eric to conclude.
Thanks, Luke. In conclusion, our value proposition really is around the value we generate in our cash flows, $100 million per year, plus the growth we can demonstrate in our portfolio, both at Singida and West Kenya. Added to that, there'll be a dividend in April. We're fully funded for the next few years to fund the Singida construction and the West Kenya growth. And frankly, we have cash flows to build both of those through to about over 200,000 ounces of production per year over the next few years. So a lot to look forward to across the portfolio, a lot of value to demonstrate, and the growth is really exciting. With that, I'll conclude and take any questions. Thank you.
Going to move straight into questions now. The first question is, what should shareholders be concerned about political risk?
Yes, well, I mean, political risk is prevalent across the world. You can see it in all sorts of countries, including the Western world. Now, the way to mitigate political risk is through strong stakeholder engagement. Now, what does that actually mean? It means you pay your taxes on time, you employ locally, and the communities benefit. Now, it's not rocket science. You have to be well liked in these places, and the people who you're working with need to benefit. You would be amazed at the number of companies that just don't follow those 3 simple principles and suffer the consequences. And we think we have a strategy in place to do that. We've been operating in Tanzania for 20 years. We've shipped 205 times to Switzerland, our gold, and we think we're in a really good position.
Thank you. A second question. Your company's stock has done well over the last 3 years. You're obviously changing your strategy, as you mentioned, from being value to value and growth. What can you tell us about how your shareholder base has changed over that time, and how do you think it might change in the future?
It's been really interesting. I mean, in October, we raised just over $40 million to fund West Kenya. As I said, the downside of permanent capital was far outweighed by the size of the prize at West Kenya. You know, they talked about being $300 an ounce of value, and the interest we had across the world was phenomenal. I mean, we had 50 meetings in a matter of 4 days. A lot of interest out of North America. A lot of groups who were keen who saw the value and, you know, couldn't quite put a finger on the growth, but could see that there was something pretty interesting. We've been institutionalized over the last month, and I continue to think that the story, you know, fundamentally is very strong and will attract the right investors.
The next question is, have you received a lot more interest from the brokerage community? And what have you been doing in your investor engagement activities to narrow the gap between EV and NPV?
Yeah, good question. So we've had a lot of groups who obviously the better you do, the more interest you generate, and that's from all of the different groups, particularly in London, looking for advisory roles. In terms of investor engagement, you know, it's as frustrating as it is, us trading at we think, you know, 0.3, 0.4 times net present value. You know, the share price has gone up 500% over the last 3 years, and we'll continue doing what we're doing, which is demonstrating the growth and pitching the value. It's a pretty simple story. A lot of cash flow we generate, a lot of growth on the other side, and a pristine balance sheet. So it will come good. It's just a matter of time.
Okay, so the next question is a request for more information about your dividend policy. You very quickly mentioned that in the presentation, but we've been asked for more information. If you can provide it, please.
Yeah, so we've committed to paying a dividend. We don't have a policy yet. We have some ideas around it, and a figure to be determined. That'll come in the new year once the board's properly considered the policy and what to commit to investors.
So the drivers for cost could the rising price of oil, for example, rising price of gold, tend to be inflation sponsored movements. How do you contain your OPEX in a world where gold price may be rising, but so will the price of oil?
Great question. Yeah. So you know, just this month, we're currently 14% of our power comes from the grid, which is clean energy. It's half the cost of fossil fuels, and that number will go up to, I think, just under 40% of our power needs in the next 3 months. I would say will come from the state grid, so electricity, as opposed to burning oil. And so that's for us one of the key mitigants. We don't hedge oil. We don't want to take a view on oil. We think it's naturally hedged against the gold price anyway. But as I said, the sooner we can get off the fossil fuels, the better.
Okay, the next question is, could you please summarize the catalyst for the next 3 to 6 months? I think you mentioned quite a lot, so maybe you could just repeat them for the benefit of the audience.
Yeah, why don't I mention two catalysts from each asset. So at New Luika, the clear catalyst there will be reserve additions and any exploration upside. And Luke's mentioned Porcupine South as a regional target that we're exploring. We have 3 rigs permanently drilling across the mining licenses and the region. A lot to look forward to there at New Luika. At Singida, that is moving into construction, and the team's been deployed. The real story at Singida is we will be drilling shortly the reserve extension, and that is a catalyst over the next 3 months, whether we can do some infill drilling to increase the reserves. And then West Kenya, the drilling will commence in the next few weeks. We've now determined the contractor. The rig has been mobilized from northern Tanzania,
and that will be drilling 9,000 meters over the next 3 to 4 months across the oxide. So there will be drilling results out of West Kenya, and hopefully there'll be resource upgrades with it.
Scotgold Resources, an AIM-listed gold company, which is commissioning the first phase of the high-grade, low-cost Canonish gold-silver mine in Scotland's Grampian Mountains. The company's got a market cap of £68 million, and we've got today the CEO of the company, Richard Gray, to present on the company. Richard, over to you.
Thank you very much, Keith. And I'll move straight on. Where I say I'm representing Scotgold. We do what we say on the can. We're producing gold in Scotland. Quickly move on through the slides. I think we can start off with a conventional title and disclaimer. Obviously, there are some forward-looking statements in this, so please read and digest. Next slide, please. So just a bit of an overview of the company. We're an AIM-listed company. We are actually Australian domiciled. That's a legacy issue, really. All our management and operations and everything are UK based. Connaught is our flagship gold and silver mine. We're predominantly gold. Silver represents about 5% of our value for those that are interested. But high grade, you're talking about 11.7 gram a ton gold equivalent, and giving us an all-in sustaining cost of around about the $600 an ounce mark. So well down the bottom quartile. I think, and then to get to where we are, we're just about to start producing, and we've done it in a phased approach. One of the issues for a gold mine of our size, which we are small, has been access to capital, which is too small for the conventional gold market players. And therefore, we've done it in a phased approach. We're going half scale for phase one, and then expanding to phase two using internally generated cash. So we're on the brink in the next few weeks of commissioning phase one. So that's essentially what we are. We're a company with a mine about to come into production. And where we want to go to is, essentially we've got a pipeline of very prospective exploration projects. So we see the Connaught mine as being the first of several. And we see Connaught being expanded. We have a highly experienced board. We've got a lot of high net worths in there, and basically that's what that makes up the predominance of our shareholder register. And they've been supported through this process, and obviously we anticipate will be there in for the long run, and they will be going forward. And so overall, what we want to do is to leverage off the learning curve we've been through, getting Connaught to this stage, to build the next ones quicker and easier. And if we can use our strong balance sheet going forward to explore and accelerate our exploration, or in sort of M&A type activity, those are all possibilities. So moving on to the next slide. Just a bit about the overall company. As I said, the top left-hand corner, that shows you our sort of very strong supportive shareholder base. Ms. Nat LaRue is our chairman and 41% holder. Bottom top right is a very simple corporate structure. We have the holding company at the top, which is public listed. Underneath that, we have SGZ Connaught, which is the entity which holds the operating mine. And then we have the Grampian, SGZ Grampian, which holds all our exploration licenses in Scotland. And we would see those licenses, we probably will spin them out into separate vehicles as and when they become advanced enough to warrant that. Our share price has obviously been on the up recently, and we've got a market cap of over 60 million, as we mentioned. And obviously, as we're getting closer to production, we see the discount to our NPV shrinking and further upside. And we believe that currently we're valued on the basis of the NPV from Connaught, but we still got other value drivers, which I'll come on to later on. So moving on to the next slide. That's just the rogues gallery of who we are. Obviously, Nat LaRue is our chairman, as a major shareholder on the top left. But all the people there have a lot of experience either in the industry and a lot of experience as wealth managers of their own funds, and have done very nicely. Thank you. So we're a team of people who know how to get things done and to generate profits and create value from that. Moving on to the next slide. So there's two main legs of the company. As I said, the first one is the Connaught mine. and I'll talk more in a minute. And then the next one is obviously then the upside potential, the exploration and development, which I'll talk about thereafter. So Colnish mine itself, as I say, we started on phase one. We had anticipated waiting approximately a couple of years to self-generate funds and fund phase two, but we've recently done a small placement, which has given us sufficient funds to actually accelerate phase two, and that will bring the phase two in the next approximately 17 months, which will bring us up to 23,500 ounce per annum on average. So moving on to the next slide. Just talk about Colnish itself. So first gold is expected at the end of November, so we're just a matter of weeks away. And as you can imagine, there's lots of frantic activity and last minute things going on up here. It's all very exciting. Next slide. This is a bit of an overview of our Colnish mine and the reserves. As I said, we're small, 550,000 tons, but very high grade. You know, we're sort of talking a 11.7 gram a ton gold equivalent. And that's what drives our low costs. It's a relatively small ore body. We've got an adit which runs through the middle of it, which is approximately 750 meters on strike, actually in the adit. The adit itself is a kilometer long, and we're going up from the adit about 160 meters up and about 80 meters down. So very compact little ore body, and that's why we think that there's plenty of scope to find more. So next slide, please. This just basically outlines what the difference between phase one and phase two is. And we've got an annual production graph there. Obviously, we're targeting the higher grade areas first. That's what gives you your graph at the bottom with the fluctuating gold production, which is obviously driven by grade. And that in turn is driven by where we are in the ore body and how much development we're doing. So in the initial years, there's a lot of ore developed from development drives, which obviously has slightly more dilution and slightly lower grade. And then we get into the stoping of the best bits, and then the grade fluctuates as per the grade model. But say small tonnages, 36,000 tons per annum, moving to 72, and relatively modest gold production from 10,000 up to 23,000 once we get into phase two. So next slide, please. This just spells out the overall of economics of the project, you know, based on that production profile. You know, we're talking about an EBITDA of 178 million, and net cash flow of 127 million, giving us an NPV at 8% discount of some 96 million. You know, they're very nice nice returns on what has been a modest capex. You know, to actually put the mine into production was in the order of about 10 million in terms of total of phase one capital. About just over 7 million peak funding. But if you add up all the historic capital on the project, which is what we've done in that bottom left slide there, 34 million, that covers all our historic exploration, and quite a lot of money spent on planning and going through the parks and so forth, which to a certain extent are a lot of school fees. We wouldn't anticipate that the next project costing us quite as much, but regardless of, even if you count all that, it's still an eminently profitable company. So it's not a case of, well, all that sunk and look forward. You know, even taking all the historic costs into effect, we're right up there. So that's the overall. In terms of phase two, what it's going to cost us to expand, you know, it's about 6.6 million, and that's broken down on the right. Essentially, it's 6.6 that'll be funded by partly from the money we just recently raised, and partly from the profits we'll make over the next 18 months. And that in turn, the reason for the 18 months is because that's a long lead time item. We can't really show much more than that. If we could, we would. The reason, as I said earlier on, the reason that we went for the phased approach in the first place was because of the constraints on funding. We struggled to get funding from the big institutions, and therefore that was really why our key shareholders stepped in, but we re-engineered the project in this way. Having stepped in, if we had the funding available on day one, we wouldn't have done the phased approach. We'd have done it, gone straight to the phase two production level. So it obviously now, if funds are available, makes sense to go to phase two as soon as possible. But say, despite the small scale, we are extremely low cost, and that again is driven by our very, very nice grade. So moving on to the next slide. It's just basically about the mine itself. We say it's a conventional long hole open stoping. practiced in many parts of the world. That's the added in red there. You can see sort of going horizontally, mining up the 160 and a ramp up and a ramp down. Processing also pretty conventional, with the exception that because we're in a national park, we don't have any cyanidation process, which means we produce two products. One is a gold doré, which is basically a gold and some silver and quite a bit of lead and whatever in the doré. That we can smelt locally, and we have the ability to sell that as Scottish gold because it has a proven Scottish provenance. The balance of the gold, some 75%, comes out as a flotation concentrate, and that we sell to the smelter directly. Next slide, please. This is just a little bit of a view of where we are with the process plant itself. Well, I was going to treat you to a little bit of a movie here with just a view around the inside of the plant building. Obviously, I said we're weeks away now from production. The key driver, the critical path activity, if you like, to getting into production has been the construction of the processing plant. This is inside the plant on a hillside on the Scottish Highlands, very remote area, very beautiful. But it's all camouflaged, if you like, from an environmental perspective. And inside things are all ready to go, and we have started the commissioning process. So next slide. And just talking about sort of commissioning the process and the camouflaging in inverted commas, we do, obviously, because we're in a national park, for this project, we're strictly and rigorously regulated by the planning authority, which is the Loch Lomond and Trossachs National Park. But we do have a very good relationship with them. Going forward, some 65% of our exploration ground is outside the national park. So, we started with the hard yards, with the hardest one. We think going forward, they should be easier. We've done the school fees on this one, and we know what to do next time around. So next slide, please. Now we move on to the exploration itself, and the exploration has two main goals. One is the sort of near mine targets to extend the life of Collinish, and the next one is obviously to find more mines at a similar or obviously potentially much greater scale than Collinish. Next slide, please. This just gives you a bit of an overview of our land areas and what's being done. As I say, we've got some 2,900 square kilometres of exploration ground under option agreement with the Crown Estate Scotland, and it sits on the Dalradian trend, which is a geological feature which extends from Scandinavia across Scotland through Northern Ireland into North America, and hosts such deposits as the Dalradian deposit in Northern Ireland, which are multi-million ounce. So although we're small, the geological area we're in is very prospective, and the ground we've got is we believe underexplored. Moving on, please. Just a little bit about the exploration, why we think the potential is there. The slide on the top left is an assay we did using soil samples of ionic leach, using the ionic leach methodology. The little black box in the middle bottom left is the outline of the actual Collinish itself ore body. Those along strike to the sort of northeast of that are all new anomalies which we've identified. So, we believe there's every prospect of finding sort of, more ground at Collinish. The reason we think that will extend the life of mine rather than necessarily enable us to expand production is because it predominantly is one vein. And so based on the sort of mining constraints of access points, etc., we believe that will lead to a extension of the life of mine. And we currently have a 9-year life. And, if one looks at the scale of those anomalies, if those were to pan out, we're talking about a significant extension. Looking further afield to the sort of north of us, we have an area called Ben Uli, which is shows the drainage anomalies with the big red blob. And where we've done soils over that, you can see we initially had nothing. We knew there's a big anomaly there. We couldn't quite pin down where was the best bit was, and the most recent results on the southeastern side there, you can see there's a gap, but we've had some very high results coming out of that. So, this is the area, we're all within a sort of 15 kilometres of Collinish where we've got the most data, and this is the area we found the most prospects so far. The rest of our land package has had nothing like the attention that this has had. So therefore, that's what gives us a belief that we're going to find a lot more of these. It's simply that we have more prospects in these areas simply because we've looked for them. So moving on to the next slide, please. Although we've got a big land package to deliver on, the thing from our side is, we want to deliver cost effectively. We're not just out there to drill Hail Mary's holes. We've got very specific objectives, which is, I say, to extend Colnish's line of life, and then to replace and expand. So to do that, we've got a very systematic process now. We're using this innovative ionic leach technique as a starter. We then use geophysics to identify the orientation, and then we get onto the drilling, which is the more expensive stuff. So, our view is over the next couple of years, we'll be catching up with the rest of the land package on where Colnish is, and we will have sort of multiple drill-ready targets to pursue. Moving on to the next slide. This basically sums up where we are. We've made the transition from an explorer to a producer with one asset. We're now expanding that. Before we've even finished the first phase, we're ready to start an expansion on the second phase. We've got significant upside on that asset from expansion. We've also got a pipeline of growth potential with more exploration ground. We've got extremely supportive shareholders. As I say, Nat LaRue owns 42%, and he does that because he's put money into the company through various rights issues, etc. We've got a commitment for sustainability. We're working in a highly regulated environment. It's highly regulated, but it's low risk in the sense that we're in Scotland. From that perspective, what security, tenure, etc., is not an issue. And that presents the market opportunity. So what we've got is a young company here, which is starting off at the bottom end of the value scale. It's got all the jigsaw pieces to create a much bigger company. And now that we're in the point of view where we have achieving production from phase one, which in 2021 will lead us through to positive cash flow, that puts us in the destiny in our own hands in terms of delivering on the exploration upside and further value for our shareholders. So I think with that, I'll hand over for any questions.
Thank you very much. The first question is, what impact has coronavirus had on your company and its operations, if any?
Well, during the lockdown period back in March, April, it obviously put a big dent in our timeline. Essentially, we were unable to take advantage of the furlough scheme. So most of our employees were furloughed. We kept on a skeleton crew who did the sort of care and maintenance of the earthworks, etc., etc. As soon as the lockdown was eased, we've been back at work. And so with the current restrictions, the guys are, there's nowhere to go for a drink in a pub after work at the weekend. But apart from that, people can get to and from work, and we're continuing as normal. There are risks associated with it. We've had a couple of scares, if you like, with one or two employees, or direct employees or contractors who've come down with COVID-like symptoms. And so we've had to apply our procedures to isolate them until they got a negative test, which, touch wood, so far everybody has. But there is always that risk that if a big group of our guys came down with it, we would need to isolate people, which then could have a delaying effect on our schedule. But it won't have a material impact on the project. It will just be a matter of relatively minor.
The next question is about the change in investor attitudes. You said you had a phased program because of funding. What were the objections, or what were the pushbacks at the time? And then how has the investor sentiment changed since then? And why do you think that is?
Well, the pushbacks at the time was we were looking for, at the time, in the order of sort of 20 to 25 million pounds. And when you go to the big conventional institutions that lend money to gold mining projects, the big banks, I can name a few, I'm sure everybody knows them. They're talking about 1 to 2 million in due diligence costs. They're normally writing tickets for 100 to 200 million rather than 10 to 20. And so that doesn't really stack up from a small company's perspective. So it made the what would have been reasonable debt finance expensive. Plus, it gives us the uncertainty that you have to wait 6 months for the due diligence process to complete, and then you go through a credit committee and you don't know if you've got it or not. So that's why that sort of didn't really work from our perspective or the institution's perspective. And going for the smaller route, the other alternative was to go through some more equity-related sort of funds. They were willing to offer us money, but extremely dilutive terms, which wasn't great for the existing shareholders, and we felt we would sort of lose control of the company by doing so. So rather than that, we re-engineered it to create a smaller first step, smaller hurdle, which then our supportive shareholders through a rights issue initially and subsequent raisings have funded. So that's enabled the current shareholders to benefit from the value of the project. In terms of how it's changed, yes, we got a lot more people now phoning me saying, "Would we like money?" Some umbrella. We've all been offered umbrellas now. The sun's coming out.
So the next question is related to what we've just talking about. So, how does the board look at debt versus equity as a source of funding today, and how might that change in the future?
Well, we don't have any big needs on the horizon for funding. That's the first thing to say. We anticipate that the funding we've got will fulfil our plans. And obviously, once the cash starts rolling in, the question was, how much do we spend on exploration? How much do we think is a prudent amount to keep us in a little bit of a war chest should any opportunities arise going forward? And then if there's anything left thereafter, what do we do about a dividend policy? So that's more on our mind than where we want to raise future money. I think throughout our objective has been to minimise dilution and get debt where we can cost effectively, and debt which as we've been very fortunate to get debt largely through our key shareholder through Natla Rue. But the debt we've looked at commercially, we didn't want debt which had a lot of strings attached to it, and potentially we could lose the company if things didn't quite pan out.
So inevitably, the next question is about your dividend policy, and can you give some more granularity about the time frame and how the board would assess the policy whenever it's appropriate?
Well, we don't have a dividend policy at this point in time. I think it's probably a bit premature to state, but I mean it's pretty blindingly obvious when you look at our numbers. We are going to be a cash cow. We're going to be producing more than we can, responsibly spend. But we do, in the short term, there are a lot of opportunities for us to improve our finances. By reducing our debt, reducing those finance costs, by increasing our exploration, so forth. So we'll spend our money on that first. There are lots of other opportunities we can do to improve the assets we've got. And once we've done all that, we'll think about the dividend policy.
Okay, thank you. So the next question is about the current plant that's being constructed, and will it process ore from additional mines, or will you have to make?
No, it won't. And the reason it won't is because being in the national park, it's a very prescriptive planning permit we have, and it's the mine which is taken from the Connaught ore body, which goes through the plant, which is located right there by the portal. The one thing the parks don't want is trucks running up and down the glen through the park. So definitely we won't be doing any toll processing. If we find just the other side of the hill, we are actually outside the park. So if there was another deposit or two we find, yes, we could definitely look at the concept of a centralised processing plant or several other deposits, and potentially those might include additional deposits to Connaught, but we won't be importing material to the Connaught plant. See that.
Okay, thank you very much. I've got one last question which we can get in. Can you expand on your gold retailing initiatives for your output?
Okay, yes, we've got two jewellers which have worked very closely with over many years. So the gold we produce through Doré goes through a chain of custody, basically with proven provenance, through the Edinburgh Assay Office, through the refiner and onto the jewellers. And because we've had the long relationship with them and they've been supportive, we've agreed with them that they will take the production for next year. They both want as much as they can get, so we will share it between them next year. Thereafter, we will look at how we will share it with other interested parties, and we have a lot of jewelers and other institutions that are very keen to get hold of our gold. And I know our gold is gold, but gold which has proven provenance in Scotland has that certain cachet that's worth something.
Paul Mylchreest, who joined Hardman back in early 2018. Paul has been an investment analyst for 30 years now. He began his mining coverage at Crédit Agricole Chèvre in 2005, having previously been an Excel rated analyst in chemicals at SG Warburg, Schroders and Citibank. He also worked for several years as a global macro and cross-asset strategist. Paul, over to you.
Thanks very much, Keith. So if I could have the first slide, please. Yeah, so I think there's a strong likelihood we are approaching the perfect storm for gold and silver as central banks and governments push the current monetary system to its limits. This presentation is going to focus on gold, but I am hopeful that silver will act like gold with an injection of steroids. And please feel free to ask me any questions about silver later. Next slide, please. I think the risk reward for gold and silver is improving. I'm going to touch on some aspects of the investment case. One of them is that there's a war out there between the forces of deflation and inflation. Also that debt cycles are very significant for gold and silver. And I'm going to try and explain how this debt cycle is different to previous ones. And I'm also going to show you how we are currently in an inflationary megatrend. And I've got some charts that may surprise you. If I could have the next slide, please. Yep, so looking at the gold price drivers, in my opinion, they dovetail with today's risks. So we've got a loss of monetary and fiscal discipline, which has only been exacerbated by COVID-19. In terms of the debt bubble, obviously counterparty risk rises as debt increases, and gold is the only financial asset that's not somebody else's liability. You may have missed this, but the FT had an interesting article a few days ago showing how the global inventory of negative yielding debt has now hit a new high of $17 trillion. And obviously that's very significant for gold, which has a 0% yield. And also, not even some market professionals don't appreciate this, but gold is actually the only financial asset which outperforms in both inflation and deflation. And the empirical work on that was done in a book by Roy Jastram called The Golden Constant, which I would highly recommend. Next slide, please. So I just want to move on to the current debt cycle. And as I say there, it's a war. We are stuck in a highly distorted final phase of this debt cycle, which is characterized by this conflict between the forces of deflation, which are inherent at this late cycle stage, and then the inflationary pushback by the central banks to try and keep the global economy and financial system in some kind of equilibrium. One of these forces is going to prevail ultimately, but my point is that either is going to be positive for gold. Next slide, please. So in terms of the deflationary force, that is the global debt bubble. I checked the IIF data a few days ago. So they currently put it at in excess of $258 trillion or 331% of GDP. just to put that in some kind of context, debt to GDP in the Great Depression in the US peaked at 275%. So we're really into uncharted territory. You may not have thought about it this way, but debt has a time function. It brings forward consumption from the future into the present. So effectively it buys time. And we've bought a lot of time. And have you noticed how central bankers never actually discussed this huge inventory of debt, which they've so actively encouraged? Next slide, please. So the pushback from the central banks and governments, I would characterize it really as the heavy hand of central planning. I see it really as the opposite of free market capitalism. If you take 6 major central banks that I highlight there, they've created $23 trillion of credit out of thin air since the great financial crisis of 2008. And I think the point is very clearly shown there with what's happened since COVID, that each time the cycle and the debt bubble looks like it's about to collapse, it takes ever more stimulus in order to try and reflate it. Next slide, please. Yeah, so let's put the current cycle in context. This is the 4th debt cycle since the Industrial Revolution. In the table, I show you there the approximate timings of the previous cycles. You can see how the current one is by far the longest. Typically, what you see in these cycles is that the debt builds up and up and up until eventually it overwhelms the system. Generally speaking, it's an equity market crash, which brings on the final winter phase, if you like, of a debt cycle and returns us to the beginning, and the cycle repeats again. The difference really, though, with this cycle is that in the 3 previous ones, we were on some version of a gold standard. This time, we have hyper-interventionist central banks, which are capable of unlimited credit creation. And that's what makes it very difficult. And they are all out to avoid deflation at all costs and to use whatever it takes. Next slide, please. Let me just run you through a classic debt cycle. I'm going to show you several economic variables, but I'll start with the dotted line, which is debt in the system. You can see from the left-hand side of the chart the starting point for each of these cycles and how typically it goes through 4 phases. So in the first one, you have the first spring phase. It's the rebirth of the economy. Debt is rising relatively slowly. You're seeing economic recovery. You then shift on to the summer phase, which is usually in part caused by a major war. So in the first cycle, 1799, that was the Napoleonic Wars. 1861, that was the American War of Independence. Then 1912 and after, you had the First World War. And then more recently in the current cycle, you had Vietnam. And that's the inflationary part of the cycle. You then move on to autumn, which is disinflationary or deflationary as growth slows down slightly, but you have asset bubbles which are driven by the rapidly rising level of debt. And then typically you get the payback into the winter phase as the economy collapses, the asset bubbles are purged, ready for the cycle to begin again. And it's this phase that the central banks are doing everything in their power to put off. Next slide, please. Here I'm just showing you the inflation rate or the price level. Some people will think of this as the Kondratiev cycle. What you can see with the dark line is that inflation typically picks up relatively slowly in the first spring phase. Then you have the rapid rise during the summer inflationary phase. Then you turn into disinflation and finally deflation. Next slide, please. Interest rates tend to follow, not surprisingly, the cycle in prices. So rising through the first two phases and then turning over and declining in the latter two phases. And, you know, we're at ZERP or negative interest rates now, which seems to corroborate that. Next slide, please. What I've just put in here is the sort of idealized rate of average GDP growth. So in the early part of the cycle, not surprisingly, it's very rapid, slows a little bit, but still very positive during the inflationary period, and then starts to slow as we get into the autumn phase, basically because the debt level has been building up and is acting as a tax on growth. And then the growth slows or actually goes negative in the deflationary phase. What you can also see along the bottom is the asset classes that you should typically buy or sell during each of those phases. And you can see that highlighting gold, not surprisingly, you want to buy gold during the inflationary summer phase and the deflationary winter phase. Next slide, please. And just to highlight how gold has tended to perform in the final stage of the three previous debt cycles, don't forget, because they have been deflationary, I've not only shown in the red columns the actual performance in gold, but also the real performance. And you can see it's basically wiped the floor with stocks and commodities. If I could find a real estate index that went back to the 18th century, I think it would do the same thing. But the other sector that's typically done well in deflation is bonds. Now I'm just going to move on, if I may get the next slide, and look at how the current debt cycle, we've seen a modification of the Bretton Woods monetary system. That was in 1968 to 1971, but I just want to make a point that it was actually preceded by a two-stage loss in US monetary discipline. The first was in the late 50s and early 60s, when the US budget deficit began to rise. And then the second of the two-stage loss was in the mid to late 60s, which was really due to the deficits resulting from the Vietnam War. But what you saw during that period was that investors began to accumulate gold in the early 1960s. Something called the London Gold Pool was formed by 6 governments who tried to sell gold to keep the $35 an ounce gold cap. And that ultimately failed because they were overwhelmed by gold buying in 1968. And that's when we saw the shift to unbacked fiat currency. So if we now shift to what we've seen since the 2008 Great Financial Crisis, and if I could have the next slide. Thank you. My question is history repeating? Are we seeing another two-stage loss in US monetary discipline? I would argue that we saw the first stage during 2008 to 2015 with ZERP and then QE1, QE2, QE3. And then I think the second stage began in the late 2018 when we saw, and I'm showing you on the left-hand chart, the dot plot from the Federal Reserve, where the expectation had been that they would continue to raise rates. And in fact, that's when it turned over and they started cutting rates. And then you can see the US budget projections currently on the right-hand chart, where although I've chopped it off, this year's deficit is going to be about 3.3 trillion. You're looking at trillion-dollar deficits as far as the eye can see. And every time I redo this chart, the bars are higher than they were previously. So my sort of gut feeling is that we're heading inexorably towards a monetary crisis. unlike previous debt cycles, this time around we have unlimited credit creation, and therefore the likely end game is actually inflationary rather than deflationary, although my suspicion is that everything will deflate, but in terms of gold. And then I just want to say, just as we move on to the next slide, please, that there's one thing that holds me back a little bit from being too upbeat on the prospects for gold and silver, and that's the structure of the London OTC gold market, where some of you may very well be aware of this, but some people still perceive the London gold market as being largely a physical gold market, when the opposite is really the case. Top left is a slide from the LBMA about the different metal accounts, and 95% of trading, and that's an LBMA figure, is basically in gold paper derivatives, something called unallocated gold, rather than actual physical transfers, which is the allocated and very small part of the market. And what I'm just showing you in those other three charts is some of the abuses that you can see in terms of the way the price performs at times. So the top right-hand chart is the average performance of gold during the London trading day. You can see how it's generally on a declining trend, and it tends to do well during Asian trading hours. Bottom left, that's just the green and red charts are two successive days of trading in the gold market. If you look, you can see how similar the green and red charts are. That is not really a random walk in my estimation. That is evidence of trading algorithms that are controlling the price. On the bottom right-hand side, I'm just showing you how for several years the gold price was essentially pegged to the yen between September 2012 and December 2017. If I could have the next slide, please. That said, since 2018, some of the banks, bullion banks' abuses of the gold market have been brought to light, and several of them have been charged for manipulating the market. And I think that has been a factor that has frustrated gold's ability to signal what is a very overstretched global financial system. My sense is that the gold bull market will really accelerate when gold bullion settlement in London becomes problematic. And if I could have the next slide, please. So moving from tragedy into hope, to quote Carol Quigley, in my view, it's not so much the amount of gold bullion in London vaults that's critical. And the LBMA likes to say how gold in London vaults is currently at a record. What's important is the float. If you take out the gold that belongs to physically backed ETFs, take out central bank gold, and then take out some gold for high net worths, hedge funds, sovereign wealths, etc. My sense from doing the calculation is there's something in the region of 600 tons of unencumbered gold at most in the London vaults. And bear in mind, if you take the official LBMA trade reporting data, they show that there's something like 1,000 tons of gold trading a day. And that actually excludes non-LBMA members, and the real total could be up to 5 times as much. So my suspicion is that London is ill prepared really to sustain another sustained wave of gold buying. And I just make the point that the vast pools of Western capital, which are typically wrong-footed by gold bull markets, still hold a very minimal amount of gold bullion in their funds, albeit that this is changing slowly. And if I could have the next slide, please. What this chart shows is the global holdings of physically backed gold ETFs versus the gold price since 2004. And what it actually suggests is that it's the non-official, the private sector accumulation of gold, which seems to be driving the gold price. So that's one reason, I'm very bullish. I see this trend as continuing, particularly if the likes of the BOE and possibly the Fed move towards negative interest rates, which they've talked about going into next year. But let me just put the current state of this battle between inflation and deflation into some kind of context. And I just wonder if you appreciate the scale of the current mega trend in inflation. And if I could have the next slide, please. We are in the fourth great inflation of the last millennium. What I just show you in that table is the approximate dates of the first three. The driving forces for these were often similar. So population growth, which put increasing pressure on available resources, and governments and kings with excessive spending policies. Now, just on the next slide, if I could have it, I just want to show you what typically happened in the final stages of those four previous great inflations. And what you see is that the price index typically rose very sharply towards the end of the first three. The question is, what's going to happen in the current one? But, I have my suspicions that we're going to see a significant increase in inflation rates at some point. If I could have the next slide, what I just want to do is show you the current great inflation, which is the red line, versus those three previous ones. And when central bankers tell you that we're in a period of low inflation, there's a comparison. The people that lived through the second price inflation from 1496 to 1650, they were so astonished by the rise in prices, they called it the price revolution of that period, but it's got nothing on where we are currently. One question you might ask is, how did those three previous great inflations come to an end? And a little bit of gallows humor at the bottom, I say you might want to look away before the next slide, but if I could have it, please. I'll let you guys read those yourselves, but you can see some of the reasons. At best, it's a reversion to sound money. One thing I'd note is in the final phases of the three previous great inflations, food prices increased faster than the general average in the latter stages. I suspect it would be food prices and other essential goods, if I could split that out. So we can only speculate what might happen this time round. My suspicion is we're going to end up in a period of much higher inflation. We may see some kind of modification to the monetary system. And, it's worth just noting the World Economic Forum, they are talking about a great reset for 2021. What exactly does that mean? Well, we'll see. If you read their blurb on it, it appears to be a little bit of a kind of socialist utopia. Remember Margaret Thatcher, who said the problem with socialism is that you eventually run out of other people's money. I think in the days of unlimited credit creation, you just print it. And then just to finish off with one more thing, if I could have the next slide. Thanks. That is the gold price versus the S&P 500 since 1971. And that to me is fairly stark, and we'll see where we go from here. Thank you very much.
Thank you very much, Paul. So we're going to have a very quick Q&A session. You've got 3 questions. Please try to be as succinct as possible, but I suspect you could talk a long time on at least 2 of the 3 questions. The first question is, if the new resources of gold in particular are becoming more scarce, more difficult to find, do you think that the large mining companies will become more acquisitive in order to replace assets, or do you think another scenario will play out?
No, I think that's exactly right. So I tend to take my lead from Barrick Gold. 1999, they bought Homestake and Placer Dome, and that was right as the bull market began. More recently, you've seen Barrick take over Randgold and tried to take over Newmont, but it didn't work out. They have great timing. And as many of the smaller companies will tell you, the big companies are good at running mines. They're not very good often at finding gold reserves. So I think it's almost certain, yes.
Okay, so just to go back to one of your opening comments, I think you described silver as being gold on steroids, or words to that effect. Could you just expand on that statement, please?
Yeah, a couple of brief points. I mean, one thing I really look at is the gold-silver ratio, which I think most people would agree at something like 75 looks completely out of line versus history. When Alexander the Great was walking the earth, it was 12.5. When Isaac Newton was the master of the Royal Mint, he set that ratio at 15.5. And most people thought they undervalued silver, and silver left the shores of England, which is one reason we ended up on a gold standard. So I think we'll eventually see some kind of mean reversion. And I think the great thing about silver is it's both a monetary and an industrial metal. Any electronic device you can think of has silver in it these days because it's the best conducting metal. So I think we've now got past the negative impact of the loss of the photography industry. And I think we're seeing growth in industrial demand and investment demand.
Okay, so I think we'll just finish on a very wide-ranging question, which I think a lot of people will be interested in, is how do you play the gold and silver markets right now? You've got certain instruments, you've got certain ways, certain strategies. What would you do? What do you think investors should be looking at?
I guess it depends on your attitude to risk. So if you want to take the lowest risk, you either you buy the metal. So you can buy a physically backed ETF, or you can go and buy sovereigns and store them at the Royal Mint. They're not subject to capital gains tax because they're legal tender. If you want to go out on the the risk side of things, you'd shift from gold into physical silver. But as we all know, silver is very volatile. That's the nature of the beast. And then you're moving through the gold mining majors into the junior players, which should have the highest returns because they are the highest risk. And I think we've put up 3 very good, interesting potential investments here today. But if none of those work for you, then don't forget you can buy ETFs, which give you a broad exposure to a number of juniors.
Thank you, Paul. Thank you very much indeed. I think we're now going to go back to Keith for some concluding remarks. Thank you very much.
So that concludes the presentations today. I'd like to thank our speakers and you, the audience, for attending this joint Hardman Co London South East Forum. Thank you very much.